We are standing at the precipice of the most significant financial regime change in a generation. For 3 grueling years, the global economy has been battered by the Federal Reserve's relentless war against inflation. But now, as 2025 draws to a close, the narrative is shifting violently toward a single, overriding question. Will 2026 be the year the Fed finally blinks? Will they pivot and cut interest rates? The answer will determine the fate of your portfolio, the housing market, and the trajectory of the global economy for the next decade. Today, we are performing a deep dive forensic analysis of the data to uncover the early signs of a cut and the massive risks lying in wait. This is not speculation. This is an analysis of the Fed's own playbook. Welcome to the definitive guide on the 2026 rate pivot. To understand where we are going, we must establish where we are right now, in late 2025. The policy of higher for longer has ceased to be a catchphrase and has become a painful economic reality. The Fed has successfully kept capital expensive, intending to suffocate demand just enough to kill inflation without killing the host. But the last mile of the inflation fight has proven agonizingly difficult. We are no longer at 9%, but we are not at the magical 2% target either. The Fed has maintained a posture of extreme patience, terrified of repeating the mistakes of the 1970s by cutting too soon. Markets, however, are losing patience. They have tried to front-run a pivot multiple times in 2024 and 2025, only to be burned by a hawkish Fed. The tension is palpable. The longer rates stay at these restrictive levels, the higher the probability that something in the financial plumbing breaks. So, what would force the Fed's hand in 2026? We are seeing 5 critical early signs. The first is the labor market. For years, the incredible tightness of the labor market gave the Fed cover to keep hiking. That cover is evaporating. We are finally seeing the normalization of the post-pandemic hiring frenzy. The fierce competition for workers has cooled significantly. The Great Resignation is over. The quit rate has plunged, indicating workers are less confident they can easily find a better-paying job elsewhere. Crucially, wage growth momentum has broken. This is the metric the Fed watches closely, as it feeds directly into services inflation. While headline unemployment remains relatively low, underemployment and discouraged worker metrics are flashing yellow warning signals. The balance of power has shifted back to employers. If this cooling turns into a freeze in early 2026, the Fed's dual mandate will force a pivot. The second and most obvious sign is the broader trend of disinflation. The fever has genuinely broken. The supply chain shocks of the early 2020s have completely normalized. The cost of moving goods globally has collapsed back to pre-pandemic levels. Goods inflation is essentially dead. In many categories like used cars and electronics, we are actually seeing outright deflation. Prices are falling. Even the stubborn shelter component of CPI, which lags real-time data by over a year, is finally reflecting the reality of cooling rents. Commodity inputs are no longer providing an upward impetus to headline inflation, signaling weaker manufacturing demand globally. Most importantly, long-term inflation expectations among consumers remain well anchored. The public does not believe high inflation is permanent. This is the crucial point. As inflation falls, if the Fed does nothing, the real inflation-adjusted interest rate gets more restrictive. They may have to cut just to stay neutral. The third sign is the exhaustion of the primary engine of the U.S. economy, the American consumer. The massive stockpile of pandemic-era excess savings is gone. It has been completely drawn down to sustain spending habits amid high prices. Consumers have pivoted from spending cash to burning plastic. Credit card debt has exploded to astronomical new highs. but the ability to service that debt is cracking. Delinquencies on credit cards and subprime auto loans are rising at the fastest pace since 2008. Major retailers are reporting a shift in behavior. Consumers are trading down, buying necessities over discretionary items, and hunting for bargains. The resumption of student loan payments has added another significant monthly headwind for millions of younger households. When the consumer hits a wall, the recession clock starts ticking loudly. The Fed knows this wall is fast approaching in 2026. The fourth early sign is the state of suspended animation in the U.S. housing market, the most interest rate-sensitive sector of the economy. Mortgage rates hovering near multi-decade highs have completely frozen transaction volumes. We are seeing the golden handcuff effect. Millions of homeowners with sub-4% mortgages refuse to sell, strangling supply and paralyzing mobility. Existing home sales volume has collapsed. The entire ecosystem of realtors, mortgage brokers, and movers is starving for volume. More dangerously, new construction financing has dried up. Developers cannot make the math work at these interest rates, leading to a future supply cliff. Housing affordability is at its worst level in history. The American dream of homeownership is mathematically impossible for a first-time buyer today. The housing sector usually leads the economy into and out of recessions. Right now, it is flashing a bright red warning signal for 2026. The fifth sign is perhaps the most terrifying for the Fed: silent tremors in the banking system. We already saw in 2023 how quickly high rates can break banks holding long-duration assets. Those underlying issues haven't vanished, they've just been masked. Banks are still sitting on massive unrealized losses on their bond portfolios. As long as rates stay high, these assets are underwater. The ticking time bomb is commercial real estate. Regional banks hold the lion's share of CRE debt, much of which is refinancing in 2025 and 2026. Trillions of dollars in commercial mortgages are coming due. Refinancing a 3% loan at 8% means instant insolvency for many property owners. In response to this risk, banks are aggressively tightening lending standards. They are hoarding capital and refusing to lend to small businesses and consumers. This is a credit crunch in real time. When the banking gear stops turning, the entire economic machine grinds to a halt. The Fed cannot ignore this for long. The data seems clear: cut rates, but the Fed is hesitant. Why? Because the risks of cutting too soon are catastrophic. The primary nightmare haunting Jerome Powell is the ghost of Arthur Burns in the 1970s: stop and go, monetary policy. In the 70s, the Fed cut rates as soon as inflation dipped and unemployment rose. The result was a massive resurgence of inflation, soaring to even higher peaks. The fear is that inflation is currently just a compressed spring. If the Fed eases financial conditions too early, demand will explode and prices will roar back. They are terrified of supercore services inflation, which is driven by wages and is notoriously difficult to kill once entrenched. Powell does not want his legacy to be the central banker who let the inflation genie back out of the bottle. He would rather cause a recession than allow that. The second risk of cutting in 2026 is reigniting dangerous speculation in financial markets, bringing back the infamous Fed put. Despite high rates, stock market valuations in late 2025 remained surprisingly rich, banking on the inevitable pivot. If the Fed signals a clear pivot to rate cuts, it would be like pouring gasoline on a smoldering fire of risk-taking behavior. We could see an immediate explosion in speculative assets, from crypto to meme stocks to housing, undoing years of necessary cooling. This creates a wealth effect. As asset prices rise, people feel richer and spend more, directly counteracting the Fed's inflation fight. The Fed does not want to be responsible for inflating another massive asset bubble right after popping the last one. They want markets to stand on their own 2 feet. The third risk is the most abstract but the most damaging: losing control of the public's psychological expectations of inflation. Inflation is largely a self-fulfilling prophecy. If businesses and workers believe inflation will remain above 2%, they will act accordingly. Workers will demand higher wages preemptively, and businesses will raise prices preemptively, creating the dreaded wage price spiral. If the Fed cuts rates while inflation is still sitting at 2.8% or 3%, they are effectively admitting defeat on their 2% mandate. Their credibility would shatter. The Fed is the central bank to the world. If they de-anchor expectations, the entire global financial system loses its primary mooring. They will only cut when they are demonstrably certain that inflation is dead and buried, not just sleeping. But the other side of the coin is equally terrifying. What are the risks if they don't cut in 2026? The most immediate risk of maintaining high rates is triggering a severe recession, the dreaded hard landing. Monetary policy acts with a long and variable lag. The full restrictive impact of the 2023-202 for hikes is only hitting the real economy now, in late 2025 and 2026. If they wait until the data confirms a recession, it's already too late. The downward spiral of layoffs, reduced spending, and corporate bankruptcies becomes self-perpetuating. The yield curve has been flashing a recession warning for years. Ignoring this historical indicator indefinitely is high-stakes gambling. A deep recession would mean millions of job losses and immense economic pain, violating the maximum employment side of the Fed's dual mandate. There is a quieter, massive systemic risk that the Fed cannot publicly acknowledge: the sustainability of the U.S. federal debt. With $38 trillion in national debt, keeping interest rates at 5% or 6% is fiscally catastrophic for the U.S. Treasury. The cost of servicing the debt has exploded, consuming a massive percentage of tax revenue, crowding out other necessary government spending. The Treasury must constantly refinance maturing debt at these punishingly high rates. It is a compounding problem that gets worse every month rates stay high. While the Fed is independent, they are not ignorant. They know that forcing the government into a fiscal crisis is a losing strategy long-term. The ultimate fear is fiscal dominance, where the Fed is forced to cut rates just to keep the U.S. government solvent, regardless of inflation. The final major risk of staying higher for longer extends beyond U.S. borders, breaking the global economy. High U.S. rates act like a giant vacuum cleaner, sucking capital out of the rest of the world and into the U.S. dollar. This forces other central banks like the ECB or Bank of Japan into impossible choices: keep pace with Fed hikes and crush their local economies, or let their currencies collapse, causing import inflation. Emerging markets that borrowed heavily in U.S. dollars are facing a solvency crisis as their debt servicing costs skyrocket due to the strong dollar. A hyper-strong dollar disrupts global trade and increases geopolitical instability. The Fed risks causing a synchronized global downturn that would eventually blow back onto the U.S. The Fed doesn't want to be the central bank that broke the world. International pressure to pivot in 2026 will be immense. So, we have the economic case for cuts and the massive risks on both sides. But 2026 is not in a vacuum. There are wildcards. First, the political dimension. 2026 is a midterm election year. The political pressure on the Fed to deliver a good economy will be deafening. While the Fed claims political independence, history shows they are sensitive to the political climate. A deep recession during an election year is a nightmare scenario for incumbents. Second, geopolitics. Energy prices have been relatively tame, but a major conflict in the Middle East or Asia could send oil back over $100 a barrel overnight. An energy shock would be stagflationary, raising inflation while killing growth, putting the Fed in an impossible position where cutting rates might not help. Any renewed supply chain disruptions could undo the disinflationary progress we've seen in goods, forcing the Fed to keep rates higher for even longer. Given all these variables, how does 2026 actually play out? Let's look at the two primary scenarios. Scenario A is the Goldilocks outcome, the soft landing. Inflation glides gently back to 2% without a recession. In this scenario, the Fed begins cutting rates in mid-2026, perhaps a total of 75 to 100 basis points over the year. Crucially, these are not stimulus cuts. They are maintenance cuts, lowering nominal rates just enough to keep real rates from becoming too restrictive as inflation falls. Markets would rally healthily. The housing market would thaw. The economy would avoid a crash. It's the perfect execution of monetary policy. This is the outcome everyone wants. It is also, historically speaking, the least likely outcome. It requires perfect timing and immense luck. Scenario B is the historical norm. The Fed waits too long, something breaks, and they are forced into emergency action. In this scenario, the cooling labor market turns into an ice age in early 2026. Unemployment spikes past 5%, and consumer spending collapses. Perhaps a major commercial real estate domino falls, triggering a credit freeze in the regional banking system. The Fed is forced to abandon its inflation fight to save the financial system. They slash rates aggressively, not by 25 basis points, but by 100 basis points at emergency meetings. Markets would initially crash on the realization of a recession, before eventually rallying on the massive injection of liquidity. The recession is mitigated, but the seeds are sown for the next wave of inflation down the road. The cycle continues violently. So, will they cut in 2026? The overwhelming weight of the data suggests yes. The economic engines are stalling. Our base case is that the Fed attempts the soft landing path, initiating cautious cuts around mid-year as inflation stabilizes near 2.5%. For investors, this means 2026 is a year of extreme transition. The era of easy 5% returns on cash is ending. Quality fixed income will likely shine. As rates fall, bond prices rise. Locking in yields now before the pivot is a consensus trade. In equities, quality matters. Companies with strong balance sheets that don't need to refinance debt will outperform those surviving on cheap leverage. The key is vigilance. The difference between a soft landing cut and a panic cut will determine winners and losers in every asset class. We are entering the final act of the post-pandemic economic drama. The Fed has kept the pressure on for longer than anyone expected. In 2026, something has to give. Either inflation finally surrenders or the economy breaks. The pivot is coming. The only questions remaining are when, how fast, and how much damage will be done before it happens. We will be tracking every data point right here. Subscribe and turn on notifications so you don't miss the signal when the pivot finally arrives.